Welcome to StockTok's deep dive into Robinhood Markets Incorporated. Robinhood is a financial services company that operates a mobile-first trading platform, democratizing access to capital markets for retail investors and traders. The company generates revenue through a combination of transaction fees, margin interest, asset management services, and more recently, venture capital placement services. As of May 13th, the stock is trading at $76.75. Over the trailing 52 weeks, the stock has ranged from a low of $57.68 to a high of $153.86, placing current levels near the middle of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Robinhood's core competitive advantage is its user experience and zero-commission trading model, which fundamentally disrupted the brokerage industry when it launched. The company built a massive retail customer base through mobile-first design and has expanded into options trading, crypto trading, and more recently, venture capital services. The business model relies on trading volume, account growth, margin lending, and cash management fees. The market sentiment around Robinhood leans bullish, reflecting the company's positioning during strong retail trading activity and expansion into venture capital, though broader headwinds from crypto volatility and competitive pressures warrant monitoring. The StockTok score is 55 out of 100, a hold. Breaking down the 5 dimensions, valuation scores 10 out of 20, suggesting the stock is not inexpensive. Financial health scores 8 out of 20, indicating some stress on the balance sheet. Profitability scores 15 out of 20. The business is profitable but margins are under pressure. Growth scores 20 out of 20, reflecting robust revenue expansion. Smart money scores just 2 out of 20, a significant red flag we will examine closely. Now, valuation. The question every investor has to answer is, are you paying the right price? Robinhood is trading at a price-to-earnings multiple of 37.13 times based on trailing 12-month results. That is a significant premium to the broader market average, which typically trades in the range of 18 to 20 times earnings. The forward price-to-earnings multiple is 37.47 times, suggesting the multiple will compress only marginally even if earnings growth accelerates. The PEG ratio, which is price-to-earnings growth, comes in at 0.0, a metric that indicates limited historical growth relative to valuation. We should note this ratio is calculated differently in different systems and may not provide a clean signal here. The EV to EBITDA multiple stands at 31.83 times, again indicating a significant valuation premium. The price-to-sales ratio is 15.25 times, meaning investors are paying $15.25 for every dollar of revenue the company generates annually. This is elevated, though for a high-margin business model, it is not entirely unreasonable. Our DCF analysis suggests the stock is trading at 0% margin of safety to intrinsic value. In other words, the current price aligns with our calculations of fair value, leaving no margin for error. Wall Street analysts covering this name, 24 in total, have a consensus mean price target of $98, implying upside of approximately 28% from current levels. The range is wide. The high target sits at $155, while the low sits at $52, reflecting substantial disagreement on fair value. Taking both signals together, a reasonable fair value range in our view sits between $85 and $110. Robinhood reported quarterly results approximately 54 weeks ago, delivering earnings per share of 42 cents against an estimate of 31 cents, a solid beat. Revenue came in at $1.07 billion, though analysts had modeled $4.61 billion, representing a significant miss driven by macro headwinds. Year-over-year revenue growth was negative 16.8%, a material deceleration. Operating income was $410 million, while net income was $350 million, demonstrating the company's ability to convert revenue into bottom-line profit. Despite the challenging quarter, management has demonstrated pricing power and operational discipline. The valuation, while elevated on current multiples, is not indefensible if the company can return to double-digit revenue growth over the next 3 to 5 years. The bear case rests on the assumption that higher interest rates and reduced retail trading activity will persist, compressing margin expansion and keeping growth rates depressed. In our view, the valuation is fair but not cheap. There is limited upside without either multiple expansion or significant earnings acceleration. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point accounting quality checklist developed by finance professor Joseph Piotroski, comes in at 7 out of 9. This score indicates solid financial health and low accounting risk. A majority of the signals are green. However, the Altman Z score, a bankruptcy risk model that weighs profitability, liquidity, leverage, and other factors, sits at 1.52. Scores below 2.0 indicate moderate distress. This suggests the balance sheet is under pressure and warrants attention. Cash relative to debt is 0.91, meaning the company has 91 cents of cash for every dollar of debt outstanding. This is a fairly tight relationship. The company does not have a material interest coverage ratio to report, which is common in financial services firms that operate differently than industrial manufacturers. The current ratio, which measures short-term liquidity, is 1.22. This means current assets cover current liabilities 1.22 times, a comfortable cushion, though not exceptional. The debt-to-equity ratio is 1.44, indicating the company carries moderate leverage. For a financial services business, this is normal, but it does mean the company is reliant on access to capital markets. In our view, the balance sheet is serviceable, but shows signs of stress. The combination of the concerning Altman Z score and elevated leverage leaves little room for error if market conditions deteriorate further. Management needs to demonstrate continued profitability and cash generation to maintain investor confidence in the capital structure. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 10.34%. This means for every dollar of capital deployed in the business, the company generates roughly 10 cents of annual profit. That is respectable, though not exceptional. A best-in-class business typically generates return on invested capital of 15% or higher. The gross margin is 85.45%, reflecting the nature of a financial services business where marginal costs are low once the platform is built. Operating margin is 46.28%, a strong result indicating management's ability to control costs and convert revenue into operating profit. Net margin sits at 41.12%, meaning the company keeps roughly 41 cents of every revenue dollar as bottom-line profit after all expenses, taxes, and interest. This is excellent and demonstrates the fundamental profitability of the business model. Free cash flow margin is 64.45%, meaning the company converts 64 cents of revenue into free cash flow, cash available to equity holders after capital investment. This is exceptional and underscores the high quality of earnings. The most recent quarterly results showed operating income of $410 million on revenue of $1.07 billion, implying an operating margin of approximately 38% that quarter. This represents some compression from the trailing 12-month operating margin of 46%, likely due to revenue headwinds and fixed cost deleverage. In our view, the business is genuinely profitable with strong unit economics. The risk is that margin compression accelerates if trading volume remains subdued or if the company must invest heavily to maintain competitive positioning. Assuming the business stabilizes, these margins should remain healthy and support ongoing cash generation. Onto growth. Is this business expanding, and at what rate? Over the trailing 3-year period, revenue has grown at a compound annual rate of 48.8%. That is extraordinary growth, reflecting the expansion from a pure trading commission model into asset management, margin lending, and venture capital services. Over the trailing 5-year period, revenue has grown at 20.2% compound annually, still robust but notably slower, suggesting some deceleration as the company matures and laps larger numbers. The most recent quarter showed year-over-year revenue decline of 16.8%, a sharp reversal driven by reduced retail trading activity and market volatility. This deceleration is the key risk to the thesis. If retail trading activity does not recover, the company may struggle to return to historical growth rates. Book value per share has grown at 9.2% over the trailing 3 years, indicating modest shareholder value creation through retained earnings. The company does not pay a dividend, so all value creation accrues to shareholders through capital appreciation and potential buybacks. Management has shown flexibility in deploying capital, recently investing in venture capital opportunities, which suggests they are willing to pursue diversified revenue streams beyond traditional trading. In our view, the growth picture is the most compelling aspect of the investment case. The 3-year track record of 48.8% revenue growth demonstrates the scalability of the platform and the massive market opportunity in retail investing. The key question is whether the company can sustain double-digit growth as it matures. Near term, we would be watching the next earnings results scheduled for July 29, 2026, where analysts are modeling earnings per share of 0.49, providing a concrete checkpoint for the growth narrative. Now let's talk smart money, what institutional capital is actually doing with this name. This is where the analysis takes a concerning turn. 10 top-tier institutional investors currently hold positions in Robinhood Markets, which signals some confidence from sophisticated money managers. However, only 8.3% of the 13F institutional filers, meaning institutions that report quarterly holdings to the Securities and Exchange Commission, are net buyers. A reading above 50% would indicate broad institutional appetite. 8.3% is substantially below that threshold, suggesting the majority of large institutions are either flat or reducing exposure. This divergence between Guru holders and broad institutional positioning is notable and warrants caution. Insider ownership stands at just 0.25%, meaning the company's own management and board members own almost none of the equity. This is extraordinarily low and suggests management has limited personal financial stake in the outcome. Over the trailing 3 months, there have been 0 insider stock purchases and 15 insider stock sales, indicating management is actively selling rather than buying. This is a significant red flag in our analysis. When company insiders are selling while the stock is near valuation levels, it typically signals limited confidence in near-term performance or near-term upside. The smart money score of 2 out of 20 reflects these warnings. This is the weakest component of the StockTok score and creates real tension with the attractive 3-year revenue growth story. One interpretation is that institutional investors are waiting for a clear catalyst before committing capital, perhaps evidence of a return to retail trading activity or successful scaling of venture capital services. Another interpretation is that the smart money understands risks that are not yet reflected in Wall Street consensus estimates. We would not place heavy weight on the Guru positioning alone, but the combination of low insider ownership, active insider selling, and weak institutional buying is a pattern that demands respect. And finally, the verdict. Let's bring it all together. Valuation, fair but not cheap, with a price-to-earnings multiple of 37 times that leaves little margin for error. Financial strength, solid profitability metrics undermined by an Altman Z score in distressed territory and elevated leverage. Profitability, genuinely excellent, with net margins of 41% and free cash flow conversion of 64%, demonstrating real business quality. Growth, the crown jewel 3-year revenue compound annual growth of 48.8% is exceptional, though recent quarter showed meaningful deceleration. Smart money, a significant concern, with minimal insider ownership, active insider selling, and weak institutional buying, despite attractive fundamentals. In our view, a fair value range for Robinhood Markets sits between $85 and $110, representing approximately 12% downside to 28% upside from current levels. The data suggests this is a story of a fundamentally profitable, high-growth business caught in a valuation and sentiment squeeze. The bull case rests on a return to robust retail trading activity, successful monetization of new services, and multiple expansion as growth accelerates. The bear case rests on persistent deceleration in trading volumes, balance sheet stress if market conditions deteriorate, and the warning sign of insider selling. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Robinhood Markets. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.